This video is solely for educational purposes. We will not be responsible for any losses or gains you may incur. Hello everybody. In this video, we'll be starting with the chapter 2 of CMT level 1, which is Dow Theory. Before watching this video, make sure that you have watched the chapter number 1. If you haven't watched it, then I've linked it in the description box below. And make sure that you have a notebook with you and you are making notes along with me. Since this is going to be really practical, we will be looking into the real charts on TradingView over and over again. So make sure to make notes and note down whatever you feel is important to you. So this chapter basically focuses on the Dow theory itself. We'll be studying the hypothesis and the theorems of Dow theory in detail, and we'll be seeing how to use that in our trading and how was it originated in the first place and what are its hypotheses. These are the basic learning objectives. So we'll be studying about the history of the Dow theory, how did it originate, who originated it, and we'll be seeing the basic principles of the Dow theory, and then we'll be seeing what primary, secondary and minor trends are, followed by how to identify upward, downward and sideways trends. And then we'll be seeing what an ideal market picture really is according to the Dow theory, and we'll be seeing how to use Dow theory for confirmation. And the last learning objective would be the role of volume in Dow theory. So we need to remember the name Charles H. Dow, after whom the name of Dow theory has been kept. So who was Charles H. Dow? We also saw in the previous chapter. He was the editor and founder of Wall Street Journal. Please write this down. Right? He was the editor and founder of the Wall Street Journal. That's the first thing. Secondly, what did Charles H. Dow do? So Charles H. Dow was the founder of the American average, which is the Dow Jones Industrial Average. So what is Dow Jones Industrial Average? In India, we have the Nifty 50 index, which comprises of the top companies of India, and we have the Bank Nifty index, which consists of all the good banking stocks, right? So the same way in the US, we have the Dow Jones index, and the Dow Jones index was founded by Charles H. Dow. Before, we used to call indices as averages. So don't get confused. Wherever you see the word average in this chapter, they're talking about the indice. Alright. One more thing. So who is the father of modern technical analysis? Charles Dow. So this is a little bit about Charles H. Dow, and you need to keep this in mind because this is really important. Alright. So Charles Dow was the founder of the Dow Jones Financial News Service, and he was also the founder and the first editor of the Wall Street Journal. So he was an experienced news reporter. Keep that in your mind that he used to be a news reporter as well. Alright. So now let's see a little bit history about how did the Dow theorems come into existence. I know this is a little bit theoretical in nature, but you need to know about this you need to know the history and where did this theorem arise from. So Dow Jones passed away when he was 52. Alright. And after that, he had a lot of successors who advanced and wrote down the Dow theory. Even after his death, his knowledge was passed on. Why? Because many of the successors took the Dow theorem and wrote it down. So now let's see how that happened. So first we have Charles Dow, right? So after his death, what happened? William Peter Hamilton succeeded him as editor of the Wall Street Journal. Alright. So William Hamilton was Charles Dow's successor. I hope that's clear, right? And then Alfred Cowell's 3 performed the first formal test of profitability. Okay, and then moving on, after Hamilton's death, the Dow theory was further written in a book by Robert Rhea. What book did Robert Rhea write? Robert Rhea wrote a book, The Dow Theory, an explanation of its development and an attempt to define its usefulness as an aid in to speculation. This was the name of the book, which was written by Robert Rhea. So this is how we got to know about what the Dow theory is, and the Dow theory stayed even after Charles Dow's death. So this is the timeline. First, Charles Dow was there, and Charles Dow was the actual father of technical analysis. He made all the Dow theorems, and then William Hamilton succeeded him. Then Alfred Cowell did the first test or the first hypothesis. Then finally, Robert Rhea was the one who wrote a book, and in that book we have been given the hypothesis and the theorem. Okay, I hope that's clear. Now let's see what Robert Rhea really did. Robert Rhea gave us the hypothesis of the Dow theorem. I hope you're writing this down, this is important. So now, what is the hypothesis of the Dow theorem? Let's see that. The primary trend is inviolate. The primary trend is inviolate. What does that mean? That means that we are talking about manipulation. So what did the Dow theory state? The Dow theory had one hypothesis, and that was the primary trend is inviolate. When I say inviolate, I mean that you cannot manipulate a primary trend. What is a primary trend? You saw in the previous chapter that a long-term trend. So the Dow theory states that it is very easy to manipulate intraday time frames, smaller time frames, but it is not easy to manipulate a primary time frame, or you cannot manipulate a long-term trend. You can manipulate an intraday trend, but nobody can manipulate the longer time frame. Whatever is there in the longer time frame, it is real. That is the first hypothesis. All right. So he claimed that the primary trend is inviolate. So that's my first hypothesis. Now let me see my second hypothesis. The averages discount everything. Now what do you understand by the averages discount everything? We saw a little bit related to this in the previous chapter. Think about it. Again, when we are talking about averages, we are talking about the index or the indices, like the Dow Jones index, like the S&P index, like the Hang Seng index, Nifty, Bank Nifty. So these are the indexes. We are talking about them. Earlier, indices used to be referred by the name as the averages. So the averages discount everything. If you remember, in the previous chapter, we saw one of the assumption that the prices discount everything. So we are going to use the same concept over here. So the Dow theory states that the averages, the indice, all the indices always discount everything, which means all the information which is available, everything is reflected in the index. Alright, all the information, all the news, all the speculation, all the profit results, every single thing is reflected in my index. Averages discount everything is because prices are the result of people acting on their knowledge, interpretation of information and expectations. So people are acting on that. That is what is seen in the price changes, right? So that is what they are saying. Now the third and the last hypothesis is Dow theory is not infallible. So what do you mean by infallible? Just because this is a stated theorem after a lot of work and hard work, that doesn't mean that this theorem will work 100% every time. You should use the Dow theory as a confirmation or as a help in your trading and investing, but this should not be the only thing which you are following blindly, because even the Dow theory is not infallible, which means it can go wrong at times. So that is one thing to keep in mind. So that's why we are saying that investment requires serious and impartial study. So these are my three hypotheses of the Dow theory. The first thing is that the primary trend is invalid. The second thing is the averages discount everything, and the third is that the Dow theory is not infallible. Okay. Now let's start with the actual theorems, and we'll also be seeing the examples in my trading view chart. So the Dow theory theorem. So one of the theorem, the first theorem is that the ideal market picture consists of an uptrend, top, downtrend and bottom. Alright. So the first theorem says that every market or any ideal market condition, ideal market would consist of uptrend, downtrend, top, bottom with retracements and consolidation. What do you understand by this? So they're talking about the ideal market. So ideal markets would always have an uptrend and a consolidation, a downtrend, a retracement, consolidation, a downtrend, right? So we have something as a top and bottom. This is my bottom, this is my top. So we'll be seeing everything in detail, don't worry about that, but just look at this. They are just saying that the ideal market would be considering these phases. Let's see examples now. Look at this. Let us go on a daily time frame. Alright. If you look at this chart, what do you see? We have an uptrend over here, right? Here we have a consolidation because the price is in the same range. Again we have an uptrend. We have a retracement because the price came down a bit. We have an uptrend. We have a retracement. Price came down a bit. Uptrend, retracement, uptrend, retracement, uptrend, retracement, uptrend, retracement. So you see that you never have a chart where it is just uptrend. You have the price moves somewhat like this. It keeps retracing, it keeps consolidating. So that is what they are trying to explain. Okay. So you know what a top and a bottom is, right? So if you look at the examples, if you look at the charts, you can see that this is the top, this is the bottom, this is the top, this is the bottom, this is the top, this is the bottom, top, 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 again. So you know how to mark the top and bottom, and I hope you do it and practice it. So this is my first theorem, and that is that the ideal market would be consisting of all of these trends. Now let's see what our second theorem is. The second theorem is that economic rationale should be used to explain stock market action. Okay, this is my second theorem. What do they mean? So one thing you need to keep in mind, for example, in our Indian markets, we have two main indexes, right? We have two main indices. One is the Nifty 50 index and the other is the Nifty Bank index, right? The same way in the US, in the Dow Jones, before they used to have two indices. One is the industrial average, which still exists. The Dow Jones industrial average is still there, and the second one is the railroad average. So they used to have one which has the industrial stocks and one was the railway stocks. Now what do you understand by railway stocks? Even though now we don't really have a railway road average anymore, we have something which has the transportation stocks of all sectors like flights, airways, buses, shipping, anything. But earlier there used to be just two indices. One was the industrial average and one was the railroad average. So the railroad average used to consist of the railway stocks and the industrial average used to have all the industrial stocks. So what they're saying is, if my industries have high profit and they're producing many goods, so their graph is rising, but my railroad industry is not performing well, if it is falling, then that is not going to be an advantage of me, because if I am producing so many goods in my industries, I need to ship it too. If my railroad average is not performing well, I won't be able to ship it. Ultimately, I'm not going to do well as an economic overall. So that is what they are saying, that we need to explain the economic rationale always. Okay. So industry may be producing goods, but if railroads are not shipping these goods, then industry must slow down. The economic rationale of goods produced and transported is still valid in the industrial sector of the economy. Where Dow's economic rationale differs from present is in the service and technology sectors have become larger in dollar volume than the industrial sector. This is my second theorem. I hope that's clear too. Now the third theorem is that prices trend. We know that the prices trend and they move in a trend. We know that prices are never moving in a random nature. We saw that in the previous chapter. So what is a trend? A trend is the general direction in which the prices tends to move. So you know that the types of trends we have: uptrend, downtrend, sideways. This we have seen in the previous chapter. Now let's see something else. Let's see the types of trends, which is the primary, secondary and minor. Don't get confused with the previous primary, secondary, intermediate. We're not talking about those type of trends. Now we are seeing about the Dow theorem trends. What does Dow theorem trend mean? They say that every single movement will have these three trends. Now let's look at them. I'll show you an example and explain it to you. Okay. Look at this. What do you see? You see that this is an uptrend, right? Higher highs, lower lows. You see that this is an uptrend. That's what you see. So that is my primary trend. My primary trend is an uptrend. Now, look at this. That's my primary trend. Now here, look at this. We have a falling nature over here. So this is my secondary trend. Why is it my secondary trend? Because now everything is falling. So even this is a major trend. Even though it is not as big as my primary trend, you see that the prices are falling over here. Now what is my minor trend? Minor trend is when inside a trend you have a little bit of movement. For example, here, look at here. You see this. For example, here, you see this. So when you have a smaller further trends inside the secondary trend, that is known as my minor trend. Let me show you another example. Let me go on a 3-month time frame. I'll be able to show it better. No, let me go on 1 week time frame. Alright, look at this now. You can see that this is a clearly uptrend, right? So that is my primary trend. Now what is my secondary trend over here? This is my secondary trend. Look at this. It is going down over here. in this phase it is going down, even though majorly it's in an uptrend, but it is going down here majorly too a little bit. So that is my secondary trend. Now inside my secondary trend, what is happening? Inside my secondary trend, I'm having a little bit of consolidation, right? I'm having my consolidation. Inside my second, I'm having consolidation. So now that is my minor trend. So I hope you understood the difference between primary, secondary and minor. Primary is the overall trend. Secondary is the trend which is inside the primary trend. And minor is the trend which is even inside the secondary trend. So that is what is my trends. Now we are coming to an interesting concept, which is the concept of confirmation. So what do you mean by confirmation? Confirming something, checking something for the second time in order to be sure about what we're doing. So Dow always ignored a movement of one average which was not confirmed by the other. So what does that mean? So Charles Dow has proposed this, that you need to always confirm your movement with the other average. For example, if my Nifty 50 index is rising, I need to check it with the Bank Nifty index. I need to see if Bank Nifty is rising too. Only then it is going to be confirmed. Both my indices should be rising together or falling together. They both should be moving in a similar pattern. Only then you can have a confirmation, because eventually both of them are linked, right? So maybe it can differ on a daily time frame. So you can see that one day the Bank Nifty did well, but the Nifty didn't do well. On smaller time frame that happens, but majorly what Charles Dow has emphasized on is the fact that you need to make sure that both of the averages are moving in the same direction, as that would give us confirmation. Okay, so that is what is my concept of confirmation. For example, if you see the charts, look at this. This is my Nifty 50 index on a weekly time frame. All right. 1 second. Okay, so this is my Nifty 50 on a weekly time frame. Let's go to the most recent and let's see what's happening in the most recent time. So if you look at the charts, what can you see? What is happening right now? Right now, it is in a consolidation phase. That's what you can see, right? That it is in the same range. The Nifty is moving in the same range, right? It's moving in the same range. Now let's go to a Bank Nifty index and see how that is moving. Do you see this? Let me remove my analysis. Support resistance lines. Yeah. So look at this. The Bank Nifty is also moving in the same range. Now if you look at the trend before it, before that the Bank Nifty was in an uptrend. Now let's go to Nifty and see that. Look at this. Nifty was also in a uptrend before the consolidation, right? Look at this. Even the Nifty is in an uptrend over here. So that's what they are saying, that you need to confirm that both of the indices are moving in the same direction. Then only it is a confirmation of the trend. If the Nifty is going down and the Bank Nifty is going up, then that is contradictory. End of the day, they both need to be going in the same direction. So we need to always confirm it with the other major index. So that is what Dow stated about the confirmation. So I hope you have understood the confirmation. Okay. We are going to end the chapter. So after confirmation, we have importance of volume. All right, this is important. So importance of volume is something which you will be using in your day-to-day trading and investing as well. You need to have a high volume which supports your direction. If there is a healthy uptrend but the volume is not much, then it is not going to sustain for a long period. It is not going to sustain for a long period. It is a weak uptrend. But if you have an uptrend and there are high volume also, and there is a high volume spike, then this is a strong uptrend supported by the volume. Understood? If I have a downtrend but I have weak volumes, which means investors are not interested in this downtrend, they are not participating, which means that the downtrend is weak and it will eventually reverse. If you have a downtrend and there is a volume spike, that would mean that the investors are interested to take the stock price further down. That means that the downtrend is strong. Alright? So now let's see some practical applications. Okay, I need to also explain something very important to you people. In your TradingView platform, this is how your chart is going to look. You won't be given a volume, but you can click on the indicators, which is FX, right? Go on technicals and search for volumes. Why is my keyboard not working? Yeah, search for volume and add that. So when you click on volume, you will get this volume chart in your graph. Now look at it in the 15-minute time frame. Okay, now look at this. We have a downtrend over here, right? With, look at this, high volumes. You see relatively, just see it visually that the graphs are big. Just see that the bars of volumes are big. Because it has high volumes, if you compare it with the previous bars, these bars are higher. That's why I'm saying that it is confirmed with high volume. So when there is a high volume, then my trend is continuing downwards. Look at this. My trend is continuing downwards because of the high volume red candles, right? The same way, let's see this. There is an uptrend over here, right? There is an uptrend. But look at the volumes. The volumes are not high at all. The volumes are very, very minute. If you compare it with these tops, if you see, this volume is blank. It is showing that the investors are not really interested to push the prices high. That is why if you see that the price went up but it couldn't sustain and it went down again from there. So that is how you are going to use your volume analysis. Let's see more examples. Okay, look at this. So you have a downtrend over here, right? And you have high volumes. These high volumes, if you compare it with these and these, you see that these are high volume selling. So because of that, my downtrend continued. But if you look at my downtrend, you can see some of the green candles as well, right? You can naturally see my uptrend here. You see, this is my uptrend, this is my uptrend. But look at the candles below. Look at the volume candles below. The uptrend candles are not much interested. This shows that the uptrend is not strong because it is not really confirmed by my volumes. My volume candles are lower as compared to the other candles. So that is how you do the volume analysis. If you want to check a trend, whether it is uptrend or downtrend, if it is supported by high volumes, then it is strong. If it is not supported by the high volumes, then it is weak. So that is my importance of volume. Alright. So those were the important concepts in the chapter. Now we'll quickly see the criticisms of Dow theory. This is the last concept. What are my criticisms of Dow theory? The first thing is that The theory will result in an investor acting after rather than before or at market tops and bottoms. So the Dow theory is something which will give you a late signal. You will be able to realize it late. You will be acting late. So you might miss most of the movement. Alright? And the second criticism is that Dow theory of the Dow theory is that different trends are not strictly defined. So different trends are not defined properly. So they're not defined properly. So when they're talking about primary trend, they're saying that it is a longer time frame. But nobody is defining what do you exactly mean by longer time frame, right? So it is not defined clearly. And the third criticism is being too specific. So the Dow theory is too specific in nature about the requirements for the change in trend, right? So that is something to keep in mind. So these are my criticisms of Dow theory. Now let's conclude the chapter. Charles Dow, although never formalized the Dow theory, his work has formed the basis for modern day technical analysis. Despite the many changes that have occurred in the securities markets over the past century, much of Dow's basic work and ideas remain pertinent today as well. So this was the concept of Dow theory, and the Dow theory, the ending book of the Dow theory was given by Robert Rea, and the hypothesis has 3 points, which is the primary trend is inviolate, the average is discount everything, and the Dow theory is not infallible. And then we also saw the theorems. So I hope that's clear. Now what you need to do is that read the chapter from your textbook, and after that go and try to mark the theorems and try to observe the theorem in the real time charts, because end of the day that is what is going to help you. And I've linked the playlist in the description box below in case you would like to watch the other chapters. Thank you.